we are going to take you through everything you need to know about crypto taxes. My goal here is to answer all of your questions before you have them, so let me know in the comments if I've succeeded and if you do have any questions that remain. We're going to cover everything from how different transactions are taxed, how to fill in your tax form, wherever the IRS can find out about your crypto, and what you can do to lower your taxes. First, something to know, I will sometimes mention cost basis, okay? Cost basis is essentially the same as purchase price of a cryptocurrency. The IRS refers to it as cost basis or basis, so I'll try and stick to that. So when I say cost basis, think purchase price. First thing to cover, tax deadlines. You are taxed on your crypto transactions between January 1st and December 31st. The tax deadline will be April 15th. And if you have difficulty remembering that, just remember it's the same day that the Titanic sank. If you need more time, you can request an extension as long as you do so by April 15th. You can potentially get an extension until October 15th. If you are making quarterly estimated tax payments, note that they are due on April 18th, June 15th, September 15th, and January 16th. Okay, now the tax deadlines are out of the way, we can talk about the big stuff. Okay, crypto is seen as property in the form of a digital asset. But all you really need to know is that this means that your crypto can either be subject to capital gains tax or income tax, depending on the transaction. So, capital gains tax applies to selling crypto, trading crypto, spending crypto, buying, selling, or trading NFTs, margin trading, futures trading, and some aspects of participating in the liquidity pool. Income tax applies to such transactions as mining, staking, receiving crypto airdrops, receiving payment in crypto, or getting a new currency from a fork. Now, luckily for us, some transactions remain untaxable. Those are buying crypto for dollars, transferring crypto between your own wallets or exchanges, giving crypto as a gift, hodling your crypto, minting or creating an NFT, soft forks, donating crypto, losing your crypto, and getting your crypto stolen. We'll be covering them in a little bit more detail later, but that's the main thing to be aware of where they taxed. Okay, so I tell you whether it's capital gains tax or income tax, but what does that mean? How much are you actually taxing these transactions? All right, so let's look at capital gains first. Your capital gains tax rate depends on three things. Your income, even though this is not income tax, but it depends on your income, whether you are married, and also how long you've held the crypto. If you've held your crypto for less than a year before selling them and you realize a gain, then that gain will be considered a short-term capital gain, and you will be subject to the tax rate of between 10 or 37%, which is the same as your income tax rate. Now for long-term capital gains, so when you've held your crypto for more than a year, the tax rate is between 0 and 20%. Okay, I'm just going to quickly or briefly show you the tax brackets for 2023. You can, feel free to pause if you want to have a look at them, and then we can go on. Okay, so those are the tax rates, but how do I know what my capital gain actually is? I know I'm taxed on my capital gains, but how do I calculate that? Now, a capital gain, simply put, is the profit on the sale of an investment. To find this gain or loss, you can subtract the the cost basis from the market value of the crypto at the time you sold it. So let's do a little example, right? I purchased one Bitcoin for $9,985 with a $15 fee. Then my cost basis is $10,000. So I can include fees in my cost basis. So now if I sell this one Bitcoin for $80,000, on top of having made a very nice $70,000, I'll also get to share this with my lovely friends at the IRS. Is calculating profit always this easy? Just define the sale price, the purchase price, here's the profit. Not quite, because say if I'm lucky enough to have acquired 10 Bitcoins over a number of years and I want to sell one of them, how do I even know which one I'm selling, right? Ideally, I'd of course want to sell the one that I acquired at the highest cost basis, because then I can incur the lowest taxable profit by subtracting it from the sale price. But can I just choose which crypto I'm selling? And the answer is maybe sometimes. It depends on which method you use to determine which crypto you are selling, and the IRS does allow for a few. I'm just going to cover FIFO and Spec ID in this one. Okay, so that's great. Now more terminology, FIFO, Spec ID. FIFO stands for first in, first out, which is nice because that's the entire rule within its name. The earliest Bitcoin you acquire would be the first one you sell. So, for example, I purchased one Ethereum for $1,000, and a week later I purchased another Ethereum for $2,000, and a week after that, I sell one Ethereum for $1,500, then I have to assume that the one I'm selling is the first one I acquired, and I would have made a $500. So that's FIFO. Now, next, let's do spec ID. That's just short for specific identification method, but that doesn't roll off the tongue quite as nicely as spec ID. So spec ID is nice because it does allow you to select which crypto you are selling. So you can always make sure to sell the crypto that would lower your profits the most, or even sell the ones that would have you incur losses, which is nice because you can deduct that from your taxable income, right? So what's the problem with spec ID? First, you can only use it within an exchange or wallet. So if I sell Ethereum on Binance, I can't choose to be selling an Ethereum that I own on Coinbase. And if you do use spec ID, you have to provide a bit more information to the IRS. So, you may be required to keep some additional records. Do be aware that if you use one method 1 year, you can't just switch to another method for the next year, okay? You have to request a change if you want to change your cost basis method. Now, I mentioned very quickly there that you can use spec ID to make a loss, right? So that begs the question, can I offset my crypto gains with losses? And better than that, yes, you can, but you can also use your crypto losses to offset any capital gain, even when they are not made through cryptocurrencies. Even if you end up with an overall net loss, so your overall losses are greater than your gains, you've offset all your gains already, you can still use those losses to offset ordinary income for the tax year, up to $3,000, which is still very nice. And you can even carry excess losses forward indefinitely. So if you've been in a crypto bear market and made a lot of losses, nice, you can use that and make the IRS pay for it. Now, before we get into all the different transaction types, let's briefly cover the forms you should be aware of when you are declaring your crypto taxes. So there's 4 main forms that I think everyone kind of needs to know. The first is Form 1040. Every taxpayer has to file one of these, and since 2023, the IRS has included a section on it where you have to check yes or no for whether you've received, sold, or otherwise disposed of digital assets during the year. So received, sold, otherwise disposed of, okay? So that means that if you've only purchased crypto or just held crypto, you do not need to check that box. Next up, the big one, Form 8949. This is where you have to report your capital gains and losses on each transaction. Okay, and if you're thinking, oh no, I've made thousands of transactions, I've ran a trading bot, so what am I going to do? Yeah, sorry, sucks to be you. No, just kidding. You can find solace in the fact that tax tools exist and they can automatically fill in this form for you. Essentially, for this form, you need to know a couple things for each of your transactions. First, you'll need to know the amount of the cryptocurrency that you are disposing of. Second, you need to know the date that you acquired the cryptocurrency you are disposing. Third, you need to know the date you sold it. You need to know the sale price. And finally, you need to know the cost basis. And from there, you can kind of calculate the rest. Don't forget that at the top of Form 8949, you have to check either box A, B, or C for short-term gains, or box D, E, or F for long-term gains. You have to use these boxes to indicate whether your exchange has provided you with a Form 1099-B, and if so, whether the basis was included or not. It's a lot to know, but it should be pretty straightforward. We're going to cover all the different transaction types, and if there is anything unusual about them, I'll let you know how to fill it in Form 8949. Your Form 8949 does have an additional complication. It is separated between short-term and long-term gains. Okay, so although it's great that you get a tax benefit on long-term gains, it does mean you have to do a little bit more work separating your transactions between short-term and long-term gains and keeping track of when they were acquired. You can use tax software such as Divly to do this automatically. Okay, this is going to be like a 40-minute video. Okay, I'm going to do a shameless plug once or twice. Schedule D is similar to Form 8949, so nothing really new is needed. The IRS just wants you to do the work twice. It's also just used for capital gains, so you can just fill in your totals from Form 8949 in Schedule D. Depending on which box you checked on your Form 8949, so A, B, or C for short-term, or D, E, or F for long-term, you'll have to fill in the corresponding capital gain summations in line 1B, 2, or 3 for short-term, and 8B, 9, or 10 for long-term. Don't forget, if you want to carry losses forward from previous years, you can do so by entering them in line 6 for short-term losses and line 14 for long-term losses. Finally, you have to fill in your total gains or losses in line 7 for short-term gains and line 15 for long-term gains. Then on line 16, you can combine the values you entered in line 7 and 15. Schedule 1 is another form you will have to be aware of, especially if you are mining crypto or earning staking rewards. You'll have to report this income on line 8Z, which is the line for other income. Okay, finally, we can discuss what you're probably here for. How is my crypto taxed? What transactions am I making? And what taxes do I have to pay on them? So selling crypto or trading crypto, okay? A common misconception is that you're only taxed when you sell crypto to US dollars or transfer US dollars to your bank account. Now, it's true that you are taxed when you sell crypto to US dollars, but you'll be taxed in quite a few other situations as well. And also, you are not taxed, by the way, on transferring US dollars to your bank account from a crypto exchange. However, what many people are not aware of is that when you trade one cryptocurrency to another, that is a taxable event. But how can that be taxable? You never even receive any dollars. You never even exited your crypto position. You're still invested in crypto. How are you even supposed to know your capital gains when you're selling a crypto to another cryptocurrency? US dollars aren't even involved. Well, the IRS just doesn't care about that, okay? You are using one currency to purchase another, and the disposal of the first currency is seen as trading it away, disposing of it, selling of it, whatever you want to call it. You are going to be taxed on any increase in value. So you'll be paying capital gains tax on any gain you make on the disposal of this cryptocurrency. For example, if you've acquired it for $10 and traded for another cryptocurrency at a time when it's worth $100, you'll have made a $90 taxable gain. And in Form 8949, you'll report this with a sale price of $100 and a cost basis of $10. Good to know is the new currency you acquired will get the cost basis of $100, so that when you trade it or sell it later, you can deduct this price from a sale price, lowering your taxable profits. Now, you probably can't hear it, but there's a baby crying outside, and it's probably because he just heard that he has to pay taxes on his crypto-to-crypto trades. I'm sorry, my man. Okay, one more quick thing to know about trades, about the holding period specifically. If I purchase Bitcoin on January 2nd and trade it to Ethereum on February 5th, then the 1 year holding period for the Ethereum commences on February 5th, okay? Not January 2nd when the Bitcoin was acquired. When the Ethereum was acquired, that's when the 1 year holding period begins. I do want to leave you with one warning regarding crypto trading, okay? Because this is something we've seen happen quite a lot. When you trade crypto to crypto, you are still invested in crypto. For most investments, when you sell them, you can set some money aside to pay taxes on your profits. You don't do that for crypto to crypto trades. You still own crypto. So if you make a large profit on the trade, but then the crypto loses all of its value after the new year, you still owe money on the profits you made in the year before, okay? And so there are large tax risks if you're investing in crypto. Always set money aside to pay taxes on your profits. And this does happen. We've spoken to people who have made $100,000 in profits and then lost it all, but still had to pay taxes on those profits. You know, that's a real Wall Street bets moment right there, where not only do you lose a lot of money, you now suddenly owe a lot of money as well. You know, that could get you quite a number of upvotes on that subreddit. And if that's worth anything to you, then at least you got something out of it. Another thing to note on stable coins. Surely those are not taxed, right? It's just the US dollars. Well, not quite, because it's not US dollars. It's just another currency cosplaying as a US dollar. It's priced the same. USDC, USDT, it's all pegged to the US dollar, but their price can still fluctuate. And any small increase or decrease in value relative to the US dollar can and will affect your taxes. Who remembers Terra USD? Okay, a stable coin, all right? At the time of this video, that stable coin is now worth 3 cents. In this case, I'd actually be pretty grateful the stable coins are actually taxable. Because if I now sell my Terra USD for 3 cents and it was acquired for $1, then at least I'll be able to share my losses with the IRS and deduct them from my capital gains. That was a lot about trading crypto. We're going to go a little bit quicker through them now. I mentioned that you're taxed when you dispose of your crypto in a crypto to crypto trade. Same goes for when you dispose of your crypto to purchase a product or service. Okay, so it's not quite the same as purchasing a good or service with US dollars. You'll be taxed on any increase in value of the crypto when you sold it. The IRS sees this kind of transaction as if you were selling your crypto for cash and then using this cash to purchase a good or service. So let's look at an example. You bought $300 worth of Bitcoin in January, and by April it is valued at $800 with a massive price increase. You see a nice couch for $800. You want to buy it. It's seen as if you were selling your Bitcoin originally acquired for $300 for $800 and then purchasing a couch. So you'll be taxed on a gain of $500 US. Now, one of the greatest parts of crypto is staking, earning your rewards by not doing anything. I love that. Passive income. What's worse than sharing your passive income with someone else? For a very long time, we've had no guidance on staking. Everyone kind of assumed that it was considered income at the time you receive it, but not everyone was willing to accept that lying down. There was a notable case called the Jarrett case, where a couple argued that their staking rewards were newly created property and shouldn't be considered income. They got the case dismissed and had the IRS issue them a refund. However, I don't think the IRS really appreciated that, because on July 31st, 2023, the IRS has finally confirmed that staking rewards are taxable income. It is what everyone was assuming anyway, but now we have kind of confirmation your staking rewards are taxable income. So you're taxed on the value of your staking rewards at the time you receive them, okay? You know what's worse? You'll be taxed again when you sell them later. So whoa, hold on. You're taxed twice? Yeah, you are taxed twice, but at least you're not taxed twice on the same value, all right? So let me explain. You receive $10 worth of Solana from your staking rewards. You'll first have to pay income tax over this $10. Then, when you sell the Solana for $25 later, you'll have incurred a $15 capital gain subject to capital gains tax. So although you're taxed twice on your staking rewards, you won't be taxed twice on the same value. Income tax on the first $10 in this example, and capital gains tax on the second $15. Mining is going to work very similarly to staking. You'll be taxed on the value at the time you receive your cryptocurrency. Your mining income contributes to your ordinary income, hence subject to income tax. So if you mine $400 worth of Bitcoin, then you can add $400 to your ordinary income, and this $400 will also be seen as the cost basis for your newly acquired crypto, which you can deduct from the sale price if you sell them in the future. However, please note that if you mine crypto, you may be seen as running a trade or business, which would subject you to self-employment taxes and require you to file Schedule C and SE. Whether you are considered as conducting a trade or business depends on the regularity of the mining and whether you have a profit motive, okay? Now, I want to clarify that part because it's about the profit motive. You can make a lot of large losses, but as long as you're looking to make a profit, you can be seen as running a trade or business. Okay, liquidity pools. It's a tough one, okay? When you dip your toes in the liquidity pool, you're providing funds to this decentralized exchange in exchange for rewards. And when you enter a pool, you are usually doing so with two currencies. For example, Ethereum and USDT. In return, you receive an LP token you can use later to get your crypto back. So where does taxes come in? First, to start with the easy parts, rewards. Any rewards you earn in liquidity pools are taxed as if it's ordinary income. So it's subject to income tax. Unfortunately, it does not end there. When you deposit your Ethereum and USDT in a liquidity pool, you receive an LP token in return. And this is seen as if it is a cryptocurrency trade. Okay, you are disposing of your Ethereum and USDT and receiving an LP token in return. Let's look at an example. Say you bought one Ethereum for $3,000 and bought 4,000 USDT for $4,000. You decide to enter the liquidity pool when your one Ethereum is worth $4,000. So you provide $4,000 worth of Ethereum, $4,000 worth of USDT. In exchange, you get an LP token. You've made no gain on the USDT disposal because it's the same value. Or check, you might make a very, very small gain or loss, doesn't matter. On the Ethereum, you will have made a $1,000 capital gain, which will be taxed. And at some point, you might want to get your ETH and USDT back. The amount you can withdraw has now changed due to impermanent loss, which is not a concept I'm going to explain here. I don't want to make this video any longer than it already is. So say you can withdraw half an Ethereum and 2,000 USDT, both valued at $2,000. Your original LP token was worth $8,000. So you're trading that for $4,000. You made a $4,000 loss. Sometimes companies, for promotional purposes, may gift crypto to your wallet. This is called an airdrop. So if you receive an airdrop, this is taxable income. The value you report can also be used as your cost basis when you need to calculate your gain or loss on disposal later. Similarly for forks, when a cryptocurrency splits in two and you receive a newly created currency, Uncle Sam wants a share, you got to pay taxes on that. Okay, let's go on to futures, derivatives, all that good stuff. When you earn crypto from futures, margin trading, other financial derivatives, you'll be subject to capital gains tax. There is no taxes when you trade on margin or buy crypto with borrowed funds, but once you close the position or you go through liquidation, there is a tax event there. So liquidation in this case is when you have to sell your collateral to cover your position. So let's take a look. Say you purchase $3,000 of Bitcoin using leverage, and that Bitcoin is now worth $5,000. You close the position, you realize a $2,000 capital gain. You'll now need to declare this in Form 8949. But what do you report now for this $2,000 gain? For the sale price, you put $2,000. Cost basis, you can put $0 because you used borrowed funds. There's also a tax benefit specifically for futures trading. Under Section 1256 of the Internal Revenue Code, if you conduct regulated futures transactions, you can automatically designate 60% of your capital gain or losses as long-term capital gain or losses and 40% as short-term, regardless of the actual holding period. Now, this is significant because, as we know, long-term capital gains are significantly more favorable than short-term capital gains. Long-term capital gains, tax rate 0 to 20%, short-term 10 to 37%. Unfortunately, most crypto exchanges are not going to have regulated futures, and sometimes it can be a little unclear on which futures are regulated. In case of liquidation, when you have to sell your collateral, the collateral could have increased in value since you acquired it, and it would be a taxable disposal. You'll be taxed on any gains, even if you have to sell your collateral. If you get paid in cryptocurrency, the IRS views this just the same as if you would have been paid in regular dollars. You have to pay taxes over the value of the cryptocurrency on the day you receive it. And if you trade NFTs, those are also digital assets. So when you sell cryptocurrency for an NFT, you're making a taxable gain. When you sell an NFT for cryptocurrency, you're also making a taxable gain. Note that sometimes the IRS may see your NFT as a collectible asset, and this could increase the value, the tax rate to 28%. Regarding minting or creating an NFT, it's a little bit unclear. It can be seen as you are producing this asset, you're selling it, so it's income tax for you. Another approach would be to consider it a capital gain for capital gains tax, and the cost you can deduct would be whatever you use to create the NFT. But it's a little unclear, so if you are participating heavily in creating NFTs, you may want to consult again with a tax professional about your situation. Okay, now that we've covered all the taxable transactions, and we're all stressed out about this, let's cool down by reveling in some untaxable transactions. I meant to use these quotes when I said untaxable, but I didn't while I said transactions. Point is it untaxable? Depends a little bit as well. So we'll cover that. First off, holding crypto. If you just buy crypto, never sell it, spend it, stake it, you won't pay taxes, okay? And we gotta appreciate those small wins, because some countries have a wealth tax and they would have to pay if they just hold crypto. All right. So if you come across anyone from the Netherlands, Spain, or Norway, you can let them know that you're better than them and you don't have to pay your wealth tax. Soft forks, unlike hard forks, do not result in the creation of a new cryptocurrency, and therefore there's no income to be taxed. Transferring crypto from one exchange to another is not taxable. Okay, we're really scraping the bottom of the barrel here when we are considering that a win. And it's not even entirely true. I kind of lied there, because if you are paying a fee in cryptocurrency to facilitate the transfer from one wallet to another, then that fee can result in a capital gain, and you would be taxed on that capital gain. So if I transfer $10,000 worth of Bitcoin from wallet A to wallet B, and I pay a 0.01 BTC fee worth $100, I originally acquired that Bitcoin for $80, I would have made a $20 taxable gain. Okay, gifting crypto, that's nice, because there's an annual gift tax exemption of $18,000 for 2024, $17,000 for 2023, and if the value of the gift is below this, you do not have to pay taxes, and you do not have to file a gift tax return. Even if you're above this limit, it's still unlikely you're going to pay taxes, because you have a lifetime gift limit of almost $13 million, and any amount above $17,000 will slowly eat away at this tax exemption limit. Considering the average net worth of an individual in the US, I do not think most people have to worry about gifting more than $13 million in their lifetime. If you do, consider yourself lucky, and I'm here for you if you do want to send a gift my way. Speaking of receiving gifts, you generally won't pay any tax on it, but damn can it be frustrating to calculate the cost basis for your gifts, okay? And realistically, it should be its own video, but I said at the start that I would answer all your questions before you have them, so now you're going to have to sit through this and let me explain to you how to calculate your cost basis on gifts that you receive. Essentially, there are 4 rules you have to consider to calculate your cost basis. Okay, the first scenario is when the value of your gift is greater than what the donor's purchase price was, because then you can just inherit the purchase price of the donor as your cost basis, and then you're done with it, and it's simple. But say the value of the gift is less than the donor's purchase price, then it gets a little bit more hectic, okay? And then it depends on the value of the crypto at the time you sell it to determine what the cost basis was. The scenarios here are whether the sale price is lower than the value of the gift and lower than a donor's purchase price, whether it is between the value of the gift and the donor's purchase price, or whether it is above the value of the gift and the donor's price. Okay, so you're beginning to understand why maybe you want to skip the gift section, because it's not done yet, okay? There's more to take into account here. If the sale price is higher than both the gift value and the donor's purchase price, you have to take the donor's cost basis as your cost basis. If the sale price is between the value of the gift and the donor's purchase price, you'll take on the value of the gift at the time you received it as the cost basis. If the sale price is lower than both the value of the gift and the donor's purchase price, then you don't have to worry about the cost basis, because you won't be able to recognize any gain or loss on the sale of the gift. Again, this system is set up in a way to prevent people from sharing capital losses amongst friends, okay? And you know what? I have to tell you something. I lied to you. There's a fifth scenario we have to consider, and it's probably the worst one. If you're a donor, the person who gave you the gift has no supporting documentation for the gift's cost basis, then the cost basis is set to 0, okay? This means you have to pay taxes over the entire value of the gift at the time you sell it. Okay, we finished gifts. I've had to do multiple takes of this. I've had to switch hands, and my arms are killing me just from gifts. But now we're on to donating crypto. When you donate your cryptocurrency to a 501c3 charity in the US, not only is it a kind-hearted move, but also a great tax play. How much you can deduct depends on how long you've owned the crypto. If you've owned it for over a year, you can deduct the entire value at the time of the donation. If you've held it for less than a year, you can deduct the lesser of your cost basis, what you originally paid for it, and the value at the time of the donation. You will have to file a Form 8283 if your donation is worth more than $500, and if it's worth more than $5,000, you have to include a qualified appraisal form. Okay, now let's cover the FAQ, which in this case I do not think is just an afterthought, but really some important questions that I could not fit anywhere else in this video. What if my exchange goes bankrupt? Unfortunately, in this case, you cannot immediately consider your crypto lost. For example, FTX has filed for Chapter 11 bankruptcy, and this does mean that at some point in the future, you may be able to receive some of your funds back. And in this case, you cannot claim capital losses. Next, can the IRS find out about my crypto? And you can thank the American Infrastructure Bill of 2021. Digital asset providers will be required to issue Form 1099s for all crypto transactions starting January 1st, 2023. Form 1099s are also directly reported to the IRS. So if your exchange provides a 1099 to the IRS, they will know about your cryptocurrencies. The IRS is even working on a specific 1099 just for crypto, and that is the 1099-DA, digital asset. The IRS has also used blockchain analysis technology as well as subpoenas to uncover unreporting of cryptocurrency taxes. But the 1099, that's the important thing to be aware of. So now you're thinking, okay, are there penalties for not declaring my crypto? You may face penalties for any of the following scenarios, right? You have reportable crypto disposals that you have not declared, you underreport your capital gains, or you have not reported your cryptocurrency income. The IRS even specifically mentions not including income on your tax return. That was shown in an information return, such as Form 1099. So if you receive a 1099, you should be declaring your income. Penalties can be as high as 75% of the taxes owed, with a maximum of $100,000 in fines and up to 5 years imprisonment. Now, of course, if you miss a sale of $20, those 5 years imprisonment is unlikely, I hope. In general cases of negligence, there is a penalty of 20% of the amount of tax on your undeclared income. And you can reduce your penalty by showing you acted in good faith and can show reasonable cause for why you were not able to meet your tax obligations. Which exchanges offer Form 1099? It should be all of them. I can say for sure Coinbase, Kraken, Revolut will offer you 1099s, but it should be everybody. How can you lower your crypto taxes? There are some pretty nice videos on this out there, but the main things are, first, hold your crypto, take advantage of your long-term capital gains. 2, sell your currencies that are making a loss. And sometimes it can be difficult to know which currencies you should sell to realize a loss. I recommend using a crypto tax tool to simulate your trades, so then you can test the impact on your taxes from selling different cryptocurrencies. We have another video completely dedicated to that, essentially, so you can check that out if you want. Third, make charitable donations, which you can deduct from your gains. Of course, maybe that's not ideal for everybody because you want to keep your crypto and not be taxed on it. So another thing you can do, number 4, is invest your crypto in a tax-deferred account. You can get tax deductions by investing your crypto in a traditional IRA. Even better, a Roth IRA allows you to invest your crypto in it, let it increase in value, all tax-free, and you can also make tax-free withdrawals from your account. Lastly, you can set up a charitable trust that would make a payment to a charity of your choice at the end of your life. However, there's many tax benefits to this and ways to still use your crypto in some form, even if it's in the trust. So I would look into that yourself, talk to tax professionals, see what possibilities are available there, and you could potentially save a lot of money on your crypto taxes. Okay, even though that was probably the question everyone was waiting for, probably the most important question is, how do you calculate your crypto taxes? So this is where I recommend using crypto tax software because crypto taxes can get very complex very quickly. Okay, earlier in this video, I said I'd plug our brand once or twice. Okay, well, this is twice. I'm going to quickly show you an example of how to do your crypto taxes with crypto tax software named Divly. First, sign up to Divly, search for your exchanges and wallets you use, upload your transaction history, download your tax form 8949, Schedule D from Divly, and declare from there. Is there anything I did not include in this video guide? Let me know. Okay, the original script for this video was like an hour and 40 minutes long, and I'm probably one of the few people who would actually want to sit down and watch a feature-length film on taxes. So unfortunately, we've had to cut quite a bit of content, but you can still read this in our tax guide on our website. For example, what do you do if you have a long-term gain but a short-term loss? How do you use TurboTax for your crypto taxes? What is a net investment income tax? And does it affect my crypto? So those are some more questions you can read on our website. I'm going to have to let you go for now, but subscribe if you want to learn more about, for example, which exchanges you should use for your taxes, because it does make a big difference. Or maybe you want to hear our ideas of how we can solve all the difficulties behind crypto tax regulations as inspired by countries that handle crypto taxes well. If those are things that interest you, we try to make some interesting content about crypto taxes. Even though, we make one of these with all the boring stuff out of the way, there's a lot of juicy content as well. So thank you for watching, and good luck on your tax declaration.